So welcome back, everybody. I am Professor Mayuri Tavde from PS Modern College of Engineering, Shivaji Nagar. And as per the request of many of the students who are studying in MBA, so they requested the basics of accounting. So I have come up with the fundamentals of accounting. So in MBA, there are a lot many students who are coming from a different background altogether. So they find the subject very difficult, or probably the basic concepts are not clear. So the number of students failing in this subject is more. So it's very easy, it's very conceptual, and again, it's not a rocket science. So I'm here to make the concepts easy for all those students who are willing to take a basic conceptual or to understand the basic conceptual framework of this managerial accounting. So point of discussion, meaning of bookkeeping, what is bookkeeping, and probably features of bookkeeping, objectives of bookkeeping, meaning and definition of accountancy and branches of accounting and basic accounting terminologies, what is we are going to see today in this video. So the video won't be of more time. I'm making a precise and short and crisp videos so everybody could access it, and multiple versions of these videos are going to come forward. So let's start. So what is the meaning and definition of bookkeeping? So bookkeeping is a process of recording business transactions in the books of accounts in a very systematic manner. So your transaction means only monetary transactions, and no other transactions are recorded in this particular bookkeeping process. So when we say that business transactions, so it only means business transactions as well as your personal transactions can be recorded into the process of bookkeeping. So the definition given by two most renowned personalities are Dr. J.R. Botley Boy. So since 11th standard, we are hearing this person's name, or we are reading the definitions of these personalities. So bookkeeping is an art of recording business dealings in a set of books. So bookkeeping is basically an art of recording business dealings in a set of books. So there are specific books which are maintained for all these set of business transactions. Then according to Notchcott, bookkeeping is an art of recording in the books of accounts the monetary aspects of commercial or financial transactions. So as I've already mentioned here, that only monetary or cash transactions are recorded into the books of accounts. So, or any kind of a financial or commercial transaction. So it is again said as it is an art of recording the business transactions. So it is the process of recording business transaction. Features of bookkeeping, what we can say, monetary transactions are only recorded. Recording is made in a given set of books, that is journal and ledger, and probably after the financial statements are being prepared from these two basic, set of books, that is journal and ledger. We are going to see it in the further videos. So for specific period, then what is the specific period for this? The specific period is from 1st April to 31st March is the standard accounting year what we follow in India, probably, right? So it is defined as per the GAAP principles and according to the Indian operating standards of accounting. So for an example, if I'm saying that my accounting year starts from 1st April 2023, so it is going to end by 31st March 2024. So the art of recording business transactions in a scientific manner. Scientific manner means there are precise procedures which are already being set for accounting. So that is why it is said as scientific manner. So objectives of bookkeeping, permanent record. There is a permanent record. Once you record the transaction, whether it is in online mode, now ERP is being developed so nicely that it records all the transactions, and it is very helpful in the further process like MRP maintenance and all other things in inventory, right? So permanent record. So once you enter your transaction into these books, into the set of books, it is permanent, lifelong, until and unless you lose it or anything happens to the record. So to know the PNL, that is profit and loss. So how much profit your business has made, how much loss your business have made, how much expenses you have incurred, and how much income you have gained for that particular accounting year. So to know the total amount of capital, how much amount of capital your business has, then comes to know the total assets and liabilities, to know the process of the business, to know legal requirements and tax liabilities. So these are the basic objectives of bookkeeping. Assets and liabilities are the two sides of balance sheet. We are going to come forward. So now I'm not going to emphasize more onto this. We are going to see detail about these statements also one by one. Let's move forward. Meaning and definition of accountancy. What do we understand by accountancy? Accountancy includes bookkeeping and classifying and summarizing and interpreting of the business transactions. So accountancy is based on these four pillars. The bookkeeping, what we have seen in the previous slides. Then comes classification. So classification of those transactions into a particular, the segregation of the transactions. So if it is a cash transaction, it should go in cash book. If it is a purchase transaction, it should go in purchase book. If it is a sales transaction, it should go in sales book. So this is how the classification what we make, the segregation of the accounts we make. So whether it is an expense, whether it is an income, again, is another type of a segregation is what we make into the P&L account. Then summarizing. Summarizing means creating the statements out of all these classification, and the classification is particularly done with the help of ledger. So after ledger, we prepare the trading and profit and loss account and the balance sheet, that is summarizing the financial statements and interpreting of the business transaction. So once you make the balance sheet is the document which is disclosed to the general public, and the interpretation of that particular balance sheet is also of utmost importance. So if I am from a particular XYZ background, I'm not from a commerce background. So definitely I should be able to interpret at least the basic things what are being given into the balance sheet. That is what is the purpose of this video is. So if somebody gives you a balance sheet tomorrow and tells you to analyze it, at least you should know the basic concepts of the balance sheet. Okay. So what do we understand? What are the definitions given on accounting? According to Kohler, accountancy refers to the entire body of theory and process of accounting. So accounting is a very wider concept altogether, if you understand. And according to Robert and Anthony, nearly every business enterprise has an accounting system. It is a mean of collecting, summarizing, analyzing, and reporting in monetary terms information about the business transactions. So nearly every enterprise whatsoever, whether in India or at global level, there are enterprises which are there who follow accounting process. So it is uh, if we can say that accounting or finance is a blood in the veins of the business. So that is how important it is. So if we have, each and every business has a financial transactions, even the unorganized sector, which are working, the chai walas and all other sectors which are working, they also have monetary transactions on daily basis, right? So they also keep the record somewhere. So branches of accounting, what we can see is accounting. There are three branches of accounting, which is financial accounting, which comes, which has the segregation as journal, ledger, trial balance, and final account. So these all three books are prepared once we say that we do financial accounting. So journal, ledger, trial balance, and final accounts, we are going to see it in the upcoming slides. Then comes the cost accounting. So what does cost accounting includes? It includes cost sheet, job and contract, process costing, operating costing. So these are the concepts which are covered under cost accounting. And what do we understand by management accounting? So it is the higher level or advanced level of financial accounting, which includes ratio analysis, break-even point, standard costing, analyzing of the financial statement or analysis of the financial statements. So this is how we can bifurcate the branches of accounting. One by one, we are going to see all together. So financial accounting, journalizing, ledger, trial balance, how we have to prepare a trial balance, how does a trial balance get prepared, and financial statements we are going to see in the upcoming videos. So the accounting process, altogether, all the businesses follow. So business documents, once you create a voucher for any kind of an transaction, that is what is said as a business transaction. I mean, business document, what you have. Uh, From it, you are going to enter the entry into a journal. So if I'm, for an example, into a journal, I have to enter a transaction. So if I take an example, purchase machinery of rupees 20,000. Okay. So purchase machinery of rupees 20,000 by cash. That is my transaction which has happened. So I have paid cash for purchasing that particular machinery, and I have purchased that machinery. So what will be the journal of it? I mean, the journal entry of it. So the journal entry of it would be that what is coming into your business. Again, the accounting rules I'm going to explain forward. I'm just giving you an example so you can get a hint of what does accounting rules and debit and credit means. So journals, while journalizing this particular entry, what we are going to do is plant and machinery or machinery is coming into your business. It is getting introduced to your business. So we are going to debit it. That is what is the asset which is coming into your business, right? So that's why we are debiting it. So machinery account debit to cash account, because cash we are paying, that is our expense, right? So that is how it is going to go. So then again, we need to record into the ledger these transactions, these types of transactions. So again, this particular transaction breaks into two. So cash will go into cash account and machinery will go into machinery account. So into the ledger, we form a separate account for each and every transactions. Then trial balance is formed out of ledger, then balance day adjustments, then adjusted trial balance, and then the final reports, which are said as trading account, profit and loss account, and balance sheet. So what is debit and credit? What do we understand by debit and credit? So before moving to this particular slide, I just want to give you an example that everybody has a bank account, right? So into the bank account, when anything or any of a transaction gets debited, that is your expense, right? And whatever you are receiving in your bank account, it gets credited. So that is your income. This is a very simple logical example. It applies to the business also. So when anything is debited, that is an expense for the business also. And when anything is credited, that is an income for the business. So you just have to relate this example with your own personal life, day-to-day transactions, and then it will be very easy to understand. So let's now move to the slide. So debit and credit are the key parts of any accounting entry. These are the two fundamental effects of each financial transaction for maintaining correct accountancy record. So for every debit, there is a credit, and for every credit, there is a debit. This is the basic rule of accounting, which comes under double entry system, which each and every business follow. There is no following of the concept which is said as single entry system, because every debit has a credit. So if there is a debit, there is a credit. And the amount of the debit and credit should match. So this is again another aspect. So let's now move to the golden rule. Once we have understood what is debit and credit, so now you'll be able to understand the golden rules as well. So what do we understand by real account? So real account constitutes all assets like building, land, road, machinery, plants, everything, which is real, which we can touch, tangible things. Okay, that is what is said as a real account. So debit what comes in and credit what goes out. Here the rule applies. When I've given the example of the machinery, right? So machinery is a real account. So it is coming into the business. So what is debited? So debit what comes in. The machinery is coming into the business, right? And the next is and credit what goes out. So again, cash is a real account. So credit what goes out. So this is a specific rule which I have applied for a single transaction, which is machinery, which is coming in, which is introduced or which is purchased in the business. Okay. So it is not always necessary that the real account transactions will only come as a transactions. No, there might be a combination of real and personal, personal nominal, nominal real. All these rules can be combined and then a journal entry can be passed. Okay. So let's move to the personal account. So what do we understand by a personal account? So personal account constitute account of partners, shareholders, capitals and drawings account, customer account. So any of the person, for an example, if I'm purchasing any kind of a good from a proprietor or a sole proprietor, right, whose name is Anand and Messrs. It's just an example, right? So I'm purchasing goods. So where I will record, I cannot say that goods are coming into the business, right? So I'll always record this particular transaction into a purchase book. So what is coming into the business? Goods are coming into the business. So what I will debit the purchase account, and what I will credit, that is Anand and Sons Limited. Why? Because I am receiving. He is the giver. Creditor is the giver. Since the rule of the personal account is credit is the giver. So who is giving us the goods? It's Anand and Sons. So here is the simple transaction, like debit what comes in and credit the giver. So there is a combination of personal and real account. So let's see the rule of personal account. So debit the receiver and credit the giver. So this is the simple rule of the accounting. Then next comes nominal account. So debit all expenses and losses, credit all gains and incomes. So nominal account constitutes of all expenses and income account and also profit and loss account. So again, if we see, all the three rules are very simple, but many a times this is the basic question for any kind of a finance domain interview. So this is how important it is. So 5 accounting elements: income and revenue. This shows the income received by a company by way of sales, interest, and all other incomes. Expenses, what does expenses include? So expenses includes all expenditure items incurred such as rent, cartridge, electricity, postage, travel, stationery, bank charges, all these comes under the expenses of the business. So income and revenue is clear, expenses is clear. So let's now move forward, and these are all the basic concepts for forming any kind of a financial statement, right? So when it comes to income and expenditure, your profit and loss account and your trading account is based on these two concepts. When it comes to equity share capital, assets and liabilities, these three concepts combinedly make a balance sheet. Okay. So what do we understand by equity share capital? So capital refers to the paid up capital of the company along with the equity shares. So if your company is a public company, so then this concept applies to it. Or else, if your company is a private company, then equity share capital is only related with the internal shareholders. Okay. So when it comes to assets, what do we understand by assets? Assets are normally debits. They are companies' movable and immovable property. And goods like cash, bank balance, goodwill, furniture, they come under the what we say assets of the particular company. And once we are moving forward, we are going to see the segregation of the asset. Asset is not just an asset, it has a sub bifurcations into it, that is current assets, fixed assets, liquid assets, and fictitious assets and all those assets. Same applies to the liabilities. Liabilities don't have that many segregations, but assets do have. We are going to see it in the upcoming videos when we are at the final stage of understanding the financial statements. So what do we understand by liability? Liabilities are credits. They indicate the amount payable by company to the creditors, such as bill payable, loans, overdraft facility if you have taken, that is what is said as liability. So liability in day-to-day life, we also have liability. We pay EMIs, we pay loans, we repay loans. So that is a liability for us. Same way, the company borrows any kind of a loan or takes an overdraft facility from the banks, or bills payable in the sense we have purchased the product first on credit basis and the bill is yet to paid. Then it is recorded in the bills payable. Why in bills payable only? Because some or the other day, the company or the business has to pay to its creditors. That's why it is recorded into bills payable. And vice versa, when it goes to accounts receivable, some or the other time, the amount is going to be received by the business. That's why we are recording accounts receivable on the asset side of the business. So I hope what is debit, what is credit, and the 5 accounting elements are much clear. So golden rules of accounting, again, into the previous slide, I have again given certain examples. We are going to see again the examples into the real life, what you will be able to relate now. Okay. So personal account, what we see, real account, we have already seen. So these are the bifurcations of personal account. So the personal account applies 3 things, okay, which is a natural person, which is an artificial person, or which is a representative person. So there is no bifurcation as such into the real account or nominal account. That's why I have not taken it. So further, I am going to explain you what personal account is. So there are 3 types into it. Natural person is the owner, Mike, Selena. Anybody can be the natural person, like you and me, who can talk, walk, and do whatnot. Okay, so artificial person. What do we understand by an artificial person? It has a status. Okay, but it is created either by company law or by statutory laws. So the companies which are formed under companies law are said as artificial person. This is the basic definition of the company law. Why the companies are said as an artificial person? Because they cannot enjoy the constitutional rights. They cannot sign on their own. They cannot make a contract on their own. But the personals are making on behalf of the company. Okay, so they are using company seal, company stamp, uh, and they are the authorized signatories to sign on that particular company stamp. That is why it is said as an artificial person. So you can see IBM is there, then Amazon is there, then Microsoft is there. So these are the companies which are being said as an artificial person. Then Reliance Industry is there, or any kind of a bank. So that bank is also said as an artificial person, but not a natural person. So representative person in the sense salary outstanding, production department. So into any kind of a outstanding salary, outstanding rent. So this is said as a representative person into the books of account. So they are representing the persons. I mean salary if I'm getting. So I am a natural person, but salary represents me into the books of account. Why? Because the salary is paid to me. Okay, I hope again the 3 bifurcation of personal account applicable to all persons is very much clear now. Then, as I was talking about the gap, generally accepted accounting principles. So they are bifurcated into concepts, assumption, conventions, principles, and accounting standards. So let us see one by one what exactly it means. So concept or assumption, what accounting is having the concept and what assumption does it makes. So business entity, then money measurement money measurement, going concern, and accounting period. So these are the concept under the accounting, generally accepted accounting principles. So when we say about business entity, what does it mean? So it is an artificial person created by the law. That is what is said as business entity, which again gets dissolved by the law only. Then comes money measurement. Money measurement is something which is the transactions which are measured in the monetary terms. So which has an exchange in terms of monetary or cash or any kind of money. Then comes going concern. So as I said in the business entity concept, that the company gets created by law and it gets dissolved by the law. So for an example, it's a very famous case in the business law, which I would like to explain here. Going concern is in the sense, there is a case where a company's board meeting was going on, and all the chairman, board of directors, and everybody was sitting in, and a bomb spot happened in that particular meeting, and all of them died. Did the company dissolve? No. The company is still going concern. Why? Because mere members cannot dissolve the company. Mere the death of the members cannot dissolve the company. But by law, it should be liquidated. And going concern in the sense, if I am establishing a business today, right? It is expected, ideally, each and every owner expects it to run for a longer period of time. Nobody is going to form a business today and close down tomorrow, right? It has certain time frame that is set as going concern. Then accounting period, definitely in the very first slides, I have explained the accounting period. That accounting period which we follow in India is 1st April to 31st March. Many of the companies, they follow from 1st January also to 31st December. Okay. So, but in India, generally, it is followed as 1st April to 31st March. Then comes conventions and principle. Dual aspect, what I said, that there is always what we say, a debit for a credit. So this is how it is said. So every debit has a credit and every credit has a debit. So realization concept, when it says that realization is said as probably when the expenses is occurring, the actual time frame where the expenses is occurring, that is what is said as realization. Cost, in that case, if we are manufacturing any kind of a product, cost is mostly related with manufacturing. So if we are manufacturing any kind of a product, what cost is related with it to manufacture that particular product? I mean, from raw material to the packaging. So cost is involved into producing that particular product. Then matching concept in the sense, when we say about the amounts, the debit amount should match the credit amount. So that is what is said as matching concept. There are certain, what we say, we receive cash discount or we receive trade discounts. Those are the concepts which will be coming into the upcoming videos. Then full disclosure. Material facts of the accounts should be fully disclosed. I mean, if we have spent probably 1 lakh rupees, 0.20 paisa, that 20 paisa should not be round up in the 1 lakh amount. It has to be disclosed. Okay. Then materiality and consistency, conservatism. Conservatism says that the books of accounts should be maintained properly. Then comes the materiality again. Materiality means the facts should be material, should be truth, should be authenticated. That is why the process of auditing is introduced into the accounting. So material facts should be disclosed to your stakeholders as well as the auditors. Nothing should be hidden from any kind of a stakeholder, whether it is an internal stakeholder, whether it is an external stakeholder. Then comes consistency. There should be a consistency in maintenance of the accounting. ऐसा नहीं है कि आज मैंने transaction किया कल मैंने record नहीं किया. No, this should not happen. So there should be a consistency in recording the transactions. And accounting standard issued by accounting standard boards. So these are certain standards which you can find on the ICAI websites. probably they have designed all the accounting standards. That is the authority who designs accounting standards for India, right? So you can find all the accounting standards which are being designed, developed by the ICAI portal. So we are coming at the end of the uh, video. So again, accounting process diagram I have brought here. So recording journal entries determine whether the particular business event has economical effect or the assets, liabilities, or equity of the business. So these are certain activities. I mean, this is the process diagram. So which includes record journal entries, post entries into accounting ledger, then prepare unadjusted trial balance, adjusting journal entries, prepare adjusted trial balance, prepare financial statement, record closing entries, and prepare a post-closing trial balance. So that is the complete cycle of the accounting is what we see. So into the upcoming videos, we are going to see all these what we say process diagram one by one. So I will be making you understand the concepts, what all things are included into a trial balance ledger, how we are going to record all the transactions. We are going to see it soon. So if you want to brush up what you have learned today, so there is a website which is said as Accounting Coach. If I click on this, okay. So Accounting Coach is a foundation which is a way old. So into this different concepts, what you learn every time, all the quiz are available online. So accounting basics, if we can see. So it is developed by CPA called as Harold Evercombe. So this is a free website, which I would recommend definitely after learning through this video, you should definitely test your knowledge. I will post the link in the bio uh, of the video. So you can access the link after each video. Okay. So which financial statement reports the revenue and expenses for a period of time, such as a year or a month? So uh, what it is. Okay, so if I click on the income statement, you will get the right answer. So you need to understand. So these are certain basic concepts what we have seen today, and there are almost 15, 20, 21 questions here. You can brush up your knowledge and you can understand how much you have understood. So there is no marking scheme for this. That is the best way of it. You just need to understand how much you have got through this particular video. Okay, so moving back to the slides. So this is my end slide, probably. I'll stop the video here. And thank you so much, everybody, for listening or understanding the concept. I'll probably make more videos on the basic concepts of accounting. Thank you so much, everybody. See you in next video.